Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss why long-term interest rates have risen despite recent Fed cuts. Amid strong economic data and the approaching presidential election, the 10-year U.S. Treasury yield jumped as high as 4.38%. Interest rate uncertainty affects various aspects of financial markets and investment decisions. Rising interest rates affect households through increased borrowing costs for mortgages, credit cards, and auto loans, while potentially also offering higher yields on savings products and fixed income investments. Over the next few minutes, we'll discuss the factors involved in the interest rate fluctuation and what investors need to know as we head toward the end of 2024. First, higher interest rates impact the economy and financial markets by increasing the cost of capital for businesses, which can potentially slow hiring and expansion and reduce profitability. As this chart shows, economic growth remained strong this past quarter, boosted by consumer and government spending, though some economists worry about the potential reversal of this trend. Mixed job market data, including a strong jobs report following the Fed's September rate cut, suggests the possibility of a soft landing scenario, though recent numbers appeared weaker with just 12,000 new jobs added in October. October's job report showed the fewest jobs added in a month since 2020, but it's important to note that strikes and hurricanes last month likely had an impact on the numbers. This chart shows the total jobs created since 2000, highlighting how strong recent job creation has been, even if one recent data point was disappointing. Despite the most recent data, the jobs market remains strong overall, with 2.2 trillion jobs added over the past year and a low 4.1% unemployment rate. As inflation continues to normalize, the Fed's attention is shifting firmly toward the labor market, making it an important indicator of rate decision-making. So, steady economic growth is one reason long-term rates might rise, even as short-term rates fall due to Fed rate cuts. In fact, that's often what leads to what's known as a steepening of the yield curve. This is not only normal, but it's often what occurs in the early stages of economic cycles. Whether this continues this time is still unclear, but it's important for investors not to overreact to recent rate movements. Finally, bond market performance can vary dramatically across sectors, with high-yield bonds gaining 7.5% and munis only 0.8% year-to-date, due to interest rate uncertainty affecting bond prices. This chart shows sector total returns sorted from the best to the worst going back to 2008. It highlights the importance of diversification across fixed income sectors, as there are no sectors that steadily outperform or underperform. Additionally, many bond sectors are offering yields above their long-term averages, with Treasury bonds at 4.3% and investment-grade corporate bonds at 5.2%. Bonds play a crucial role in portfolio diversification and income generation. So, while it's not clear what will happen next, holding a diversified fixed income portfolio can help to protect against downside risk while taking advantage of favorable interest rates. We've only scratched the surface on this important topic. If you would like to discuss interest rates and the portfolio considerations in more detail, please feel free to reach out. We look forward to speaking with you soon.